Introduction. Cost accounting explains where money goes in producing goods or services. It helps leaders understand why costs occur, whether spending is justified, and how pricing or processes should be improved. Cost. Cost represents the sacrifice of resources, such as materials or labor, to gain something useful. Understanding cost reveals the true effort and value behind every business activity. Costing. Costing measures how much a product or service really consumes in resources. It turns raw transactions into meaningful figures managers can use for planning and control. Cost accountancy. Cost accountancy applies rules and techniques to cost information, allowing management to decide whether operations are efficient or require adjustment. Cost accounting. Cost accounting identifies, records, and analyzes cost data, so decisions are fact-based. It focuses on internal needs, guiding improvements rather than complying with external reporting rules. Cost components. By breaking costs into materials, labor, and expenses, cost accounting shows which part drives spending, helping managers target the right area for savings. Specialized branch. Cost accounting stands apart from general accounting because it goes deeper into how and why money is spent, not just recording totals. Art and science. It uses structured rules to measure costs, but requires judgment to interpret results, turning numbers into meaningful actions rather than just data. Profession. Cost accounting is practiced under professional standards that ensure accuracy, reliability, and ethical handling of financial information. Operational focus. Unlike financial accounting, which reports past results to outsiders, cost accounting helps insiders decide whether to improve processes, reduce waste, or change pricing. Scope expanded. Classification of cost. Costs are grouped by type, purpose, or behavior, so managers can see patterns, like which items increase when production rises and which stay fixed. Cost recording. Recording costs in ledgers keeps spending visible and traceable, enabling accountability and easier review when problems arise. Cost allocation. Assigning costs to departments or products shows how resources are consumed, preventing one area from hiding excess spending behind another. Cost determination. Determining cost reveals the real expense of producing each unit. Without this, businesses misprice items and lose profit unknowingly. Cost control. Comparing expected and actual costs highlights inefficiencies. Managers can correct issues early rather than waiting for losses to appear. Cost comparison. Comparing costs over time or with other firms shows whether improvements are working or if changes are needed. Cost reduction. Unlike temporary savings, cost reduction seeks permanent improvements by redesigning processes or reducing waste, not lowering quality. Functions expanded. Cost ascertainment and profitability. By identifying true costs at each stage, managers see which products earn profit and which silently drain resources. Decision support and pricing. With reliable cost data, leaders choose whether to make or buy components, use facilities fully, or set prices that reflect real effort, not guesses. Compliance and cost audit. Where required by law, cost audits confirm methods are valid, protecting investors, customers, and regulators from misleading financial information. Summary. Cost accounting explains not just what money is spent, but why and how it affects operations. It turns raw costs into decisions, showing where waste occurs, which activities are profitable, and how pricing should be set. so managers can improve results with confidence.